Tosin, thank you so much for joining us. Of course, there's always a big focus on the OMO auctions of the central bank. Can you just talk us through what we are seeing there and what we're learning in terms of their posture towards interest rates and, of course, foreign investors?
Yes, what we noticed is the central bank governor continues to have its weekly auctions to manage the amount of maturities that are already lined up per week for OMO, but their focus seems to be on the offshore investors, those who are allowed to participate in that auction. What that has caused is a bit of activity in the secondary markets for banks. Banks have to look for where to, they also have maturities as well, have to look for where to invest those OMO maturities. And so their OMO maturities are really active on the bank side because they're the ones that can trade that. Then the offshores are the ones that are enjoying the best available at the primary auction for the OMO.
All right. So the market has been segmented, as you've just discussed. But overall, how do you see this new liquidity that has to find a house somewhere, in this financial market, impacting yields further? We saw that yields really went down. I think we even saw 3% or thereabout, and then they picked up a little bit. And do you think that they could fall back again, given what we know in terms of the liquidity that is coming?
Yes, for local investors, they've had to be a bit more creative in assets that they can invest and looking for yields. And we've noticed that a lot of clients have now expanded their kind of assets that they look at from the T-bills and looking into other assets like CPs. There have been a few issues of CPs, and you've seen a lot of investor interest there. Some corporate bonds also as well, but on the short to medium space again. FGM promissory notes that were issued to exporters and oil marketers. We've seen a lot of secondary market activities on those as well. Investors looking for yields above what's available in the NTB space. NTB yields are really low.
But the point I'm trying to get to is, do you think those NTB yields would even fall further? Because there are only so many CPs out there, and I just get the sense that if the liquidity continues to, from what I'm hearing, we could see a lot more coming, then we really have, there's no other way but south in terms of yields for NT bills.
Yes, I agree with you. Yields are pressured because of the demand. Demand is heavy. There's a lot of liquidity. Investors have to invest. But there's always bottom parts, like a level in which investors will not look at those yields. I think around 4% is like the minimum investors will take, and they start looking for something better than that. Like I said, the promissory notes issued by the FGN have a bit more attractive because they offer higher than where NTBs trade. So you see a lot of investor interest from on the institutional side. So you have a lot more asset managers, and institutional investors going into that space. It's not a bit so active or available for the retail investors, at least not yet, because of the volumes that trade in that space. But I think that there's a minimum, maybe around 4% that investors will look at.
But of course, the yield curve is quite steep now when you look at what's potentially available on the longer end of the curve with the bonds. Do you see that flattening, or how do you see things evolving in terms of investor interest, especially on the long end in terms of bonds?
Investors, are more or less fighting for where do they put their monies, right? And you see that in the heavy demand that we saw at the bond auction yesterday, about 282% oversubscribed. And the DMO the DMO, according to his plans for how much they want to raise for this year and in Q1, are more or less done. So they are not under pressure to borrow as much, and therefore rates don't need to go up that much. Even today, for example, the markets closed about 30 points lower from where it closed, about 15 points, lower from where it closed yesterday, just because of the effect of the auction. So you see that demand heavy, especially at the long end of the market, the 2049 30-year bond that still gives something close to 12%, yield. So demand is still, we expect that demand pressure to be consistent, especially from the local investor side.
All right. We've seen a recovery in the oil price, but very quickly, if you can just speak to the expectations for the exchange rate, how do you see things evolving, especially if we can see that oil price still remains somewhere close to $60?
I think the exchange rates will remain stable. The central bank has done a lot of work to remove pressures on the exchange rates. It's made the environment good for foreign investors. It has extended the curve for the OTCFX futures to encourage FDI inflows. You know, you're hearing things like a new PIB bill in the works that would, could look to bring more investment into that sector. So things are positive for Nigeria in terms of exchange rate now. The central bank governor has done a lot of work to, make that stable as much as possible, and I think that's going to hold for the interim.
All right, let's leave it there. Thank you so much for speaking to us today. Oluwatosin Ayanfalu, fixed income broker at Zedcrest Capital.